This week, the US Treasury Secretary asked the Federal Reserve to build a bigger door, one that lets a foreign government swap its US debt for fresh dollars anytime it needs to, without ever selling a single bond on the open market. That request alone moved through the financial press like wildfire, and by the time you finish this video, you'll understand exactly why two stocks are already reacting to it. Now, most people hear a headline like Fed weighs new repo facility for Japan, and their eyes glaze over. Central bank plumbing sounds like something for a Bloomberg terminal, not your brokerage account. And normally I'd agree with you. But here's the thing almost nobody explains well. Every single time the Fed builds, expands, or opens up a new pipe for dollars to flow through the system, the same pattern tends to play out afterward. Asset prices move, specific sectors get a tailwind, and the people who understand the plumbing position themselves days before everyone else is still arguing about the headline. So here's the plan for the next 19 minutes. First, I'm going to break down exactly what got requested this week, why it's a bigger deal than the two-sentence news story lets on, and the almost identical playbook the Fed ran back in 2023 during a completely different crisis. Then I'll walk you through two stocks already moving because of this. One mega cap that just clawed back above a valuation level analysts have been watching closely, and one merger arbitrage story that most investors have already written off as dead, except the situation just quietly got a lot more interesting. Let's get into it. Let's start with what actually happened, because a lot of the coverage out there has gotten this slightly wrong, and getting it right is the whole key to understanding the trade. This past Friday, the United States and Japan carried out a joint currency intervention, buying Japanese yen together for the first time since 2011. That's not a typo. The last time these two countries stepped into the market side by side like this, Barack Obama was in his first term. The yen has been sliding toward levels not seen in roughly 40 years, and Treasury Secretary Scott Bessent has openly called it very undervalued. But buying yen costs dollars, and that raises an uncomfortable question. Where does Japan get them? Historically, the answer has been simple. Japan sells US Treasury bonds, the government debt it's been holding for decades, and uses the cash. The problem is, Japan is the largest foreign holder of US government debt on the planet, sitting on more than $1.1 trillion of it. When a holder that large sells, it floods the market with supply, and bond yields creep higher. Higher yields mean pricier mortgages, pricier corporate borrowing, and a more expensive bill on America's roughly $40 trillion debt pile. So on Sunday, Bessent did something that turned this into a much bigger story than a one-off currency intervention. He publicly asked the Federal Reserve to expand a facility most people have never heard of, the FIMA Repo Facility, short for Foreign and International Monetary Authorities. Think of it as a pawn shop for central banks. Japan walks up, hands the Fed a stack of US Treasuries as collateral, and walks out with dollars. Later, it reverses the trade, pays a small fee, and gets its Treasuries back. No selling. No flooding the bond market, no spike in yields. Here's the part that matters most. This facility already existed. It was born in March 2020 during the pandemic, panic, and made permanent in 2021. But it's capped at $60 billion per country, and Bessent wants that ceiling raised. His own words were that the Fed should encourage it to be upsized in the coming months. Japan's finance ministry has now confirmed it plans to actually start using this facility going forward. And all of this lands on the desk of Kevin Warsh, who was sworn in as the Fed's new chair back in May, and who now has to decide, together with the rest of the Fed's policy committee, whether to grant that request. So this isn't the Fed doing something wild out of nowhere. It's the Treasury Secretary asking an independent Fed to quietly build a bigger pressure release valve, so that when a US really needs dollars, it doesn't have to unload American debt onto a jumpy bond market to get them. Now here's why I think this matters more than the headline suggests, and it comes down to a pattern I've watched play out before. In March 2023, Credit Suisse, one of the largest banks in the world, was collapsing. The Swiss government was scrambling, and that same weekend, 5 other central banks joined the Fed in a coordinated statement to enhance US dollar liquidity. Days later, Credit Suisse was forced into an emergency merger with UBS, with US authorities quietly helping backstop the deal. To be precise about the mechanics, what central banks used in 2023 were currency swap lines, a slightly different tool where central banks exchange currencies directly with each other. FIMA Repo works through Treasury collateral instead of a straight swap. Different plumbing, same underlying instinct. Get dollars where they're needed without forcing anyone to dump assets on the open market. That's the pattern I want you to notice. It's not that the Fed causes a crisis. It's that when a facility like this suddenly gets urgency and a request to expand it, that's usually a signal that stress is building somewhere in the system, and policymakers are trying to get ahead of it quietly before it becomes a headline nobody can ignore. So what do you actually do with this information? Here's the single most useful takeaway. Historically, when the Fed builds or expands a new way to pump dollars into the system, asset prices tend to drift higher over time, not because companies suddenly became more valuable overnight, but because there are simply more dollars chasing the same pool of assets. Meanwhile, cash sitting on the sidelines quietly loses purchasing power. It's the ice cube on the counter in summer. Looks perfectly fine right up until it doesn't. That doesn't mean panic buying anything with a ticker symbol. It means paying attention to where money is actually flowing, not where you assume it should be. If you want the full breakdown of the FIMA mechanics and the sourcing behind everything in this video, there's a free companion write-up linked in the description. All right, let's get into the two stocks. Stock number 1 is Alphabet, Google's parent company. I know everybody already knows Google, fair, but almost nobody is looking at the actual numbers right now, and the numbers tell a very different story than the narrative. As of early August, Alphabet is trading at roughly 17 to 19 times trailing earnings, depending on the day and how you treat some one-time investment gains on its books. Either way, that's close to its lowest valuation multiple since 2019, even after the stock has already climbed nearly 90% over the past year. So why does a company up that much still look historically cheap? Because the business underneath has changed. Google Cloud pulled in $24.8 billion last quarter alone, up 82% year over year, with a healthy 35.6% operating margin. Its backlog of already signed cloud contracts sits at $514 billion, and Alphabet says more than half of that converts to actual revenue within the next 2 years. That's not speculative growth, that's demand that's already been paid for. Search revenue itself climbed 17% to $63.3 billion in the quarter, and Google's AI mode has already crossed 1 billion monthly users. That matters because the other big worry hanging over this stock has been whether AI chatbots eat Google's search business alive, but paid clicks were still up 13%. So for now, the search engine looks like it's adapting rather than getting replaced. Then there's the AI infrastructure piece. Google is backing a roughly $15 billion financing package, led by Morgan Stanley, for a massive new AI data center campus in Hubbard, Texas, one built specifically to run Anthropic's workloads. Google is guaranteeing several of Anthropic's lease and power obligations, and in exchange, it's expected to pick up close to a 20% equity stake in the project, on top of supplying the AI chips that will run inside it. That reframes a chunk of Google's enormous AI spending. Instead of building capacity and hoping someone shows up to rent it, it's building capacity for a tenant that's already under contract. Now, a balanced look means I can't just give you the highlight reel. Alphabet's free cash flow actually went negative last quarter, about negative $5.9 billion, because capital spending on AI infrastructure is running ahead of the cash coming in. The company raised its 2026 capital spending guidance to somewhere between $195 and $205 billion, and management says 2027 spending goes even higher. That's a real cost worth watching. But Alphabet is also sitting on $242 billion in cash and marketable securities against only about $98 billion in long-term debt. So this is a company that can afford to spend aggressively without stretching its balance sheet to the breaking point. Chart-wise, the stock fell to around $315 in late July after earnings spooked some investors over capital spending, then clawed back nearly 14% within days as the cloud numbers and the Anthropic deal sank in. That kind of sharp recovery off a post-earnings low tends to catch institutional attention, not because Buffett owns it, though he does, but because a company generating this much cash flow, at this valuation, with demand this visible, is hard to ignore for long. To be clear, I'm not telling you to buy Alphabet, I'm telling you why it's on my radar, and you can weigh the same facts and land wherever you land. Quick pause here, because I want to flag something useful. If you're trying to build your own watch list around stories like this one, mega cap valuation resets, merger arbitrage situations, Fed-driven sector rotations. That's genuinely a different skill than picking a stock because a video told you to. There's a short companion guide on exactly how I screen for setups like these two, linked in the description. No cost, no sign-up wall. Okay, now let's get into the story almost nobody else is covering correctly right now. Stock number 2 is ZIM Integrated Shipping Services, an Israeli container shipping company most people have never had a reason to look at. I want to walk through this one carefully, because a lot of finance content out there is currently telling a version of this story that's already out of date. Back in February, German shipping giant Hapag-Lloyd agreed to acquire ZIM for $35 a share in an all-cash deal, valuing the company at about $4.2 billion, a hefty 58% premium to where the stock was trading right before the announcement. ZIM's board unanimously approved it, and by May, ZIM's own shareholders voted to approve the deal too. On paper, that should have been the end of the story, except it isn't. Because of one detail buried in the fine print, the State of Israel holds a special state share, essentially a golden share, in ZIM, and the deal cannot close without the Israeli government signing off on transferring it. The government has not been quiet about its discomfort. A Knesset panel raised national security concerns back in February. Israel's transport minister ordered a formal review, and on July 6, ZIM shares dropped more than 7% in a single day on reports that the government was actively moving to block the sale outright, partly over concerns that Hapag-Lloyd's own shareholder base includes sovereign wealth funds from Qatar and Saudi Arabia, and partly over keeping strategic shipping capacity under Israeli control. Here's where most other breakdowns stop the story, with the deal looking dead in the water. But here's the update almost nobody's covering. A second bidder has entered the picture. A group called Sakal, alongside partners, has proposed acquiring ZIM for $37.50 a share, about $4.5 billion, and critically, their offer pledges to keep Israeli operational control of the fleet intact, along with a $250 million employee bonus pool. In other words, there's now a real, higher-priced alternative on the table that directly answers the political objection that's been sinking the Hapag-Lloyd deal. That is a meaningfully different setup than the deal is dead, and it's the kind of update that can move a stock fast the moment it gets resolved one way or the other. Now let's talk about what you're actually buying today, regardless of which offer wins. ZIM currently trades around $27 a share, with a market cap in the neighborhood of $3.2 billion. As of its most recent quarterly report, the company held about $2.5 billion in total cash and short-term investments. But I want to be precise here because I've seen other breakdowns skip this part. ZIM also carries meaningful debt, mostly tied to vessel charter obligations, putting its net debt position at roughly $2.9 billion, with a leverage ratio of about 1.7 times. So this isn't quite the "you're basically getting paid to own the fleet" story some content makes it out to be. That framing undersells the real debt load. What it is, though, is a company trading at a real discount to two live binding cash offers, about 30% below the Hapag-Lloyd price and closer to 39% below the Sakal proposal, if either one closes as written. On top of the merger story, there's a genuine industry tailwind worth knowing about. Ongoing security concerns in the Red Sea have kept container ships rerouting around the entire African continent instead of through the Suez Canal, removing something like 8 to 10% of effective global container capacity, even as trade groups peg global container volume growth in the low to mid-single digits this year. Longer routes plus growing demand, plus a fleet that hasn't grown to match it, means tighter capacity and firmer freight rates over time, and ZIM operates one of the youngest, most fuel-efficient container fleets in the industry, well-positioned if that squeeze continues. So here's the honest picture: a binding $35 offer facing real political headwinds, a fresher $37.50 DOLLAR counteroffer that might clear the one hurdle that's been in the way, and an underlying business with real debt but also real exposure to a tightening shipping market. That's a genuinely asymmetric setup. Meaningful upside if either deal closes or the freight cycle turns. Real risk if the whole acquisition collapses and ZIM has to stand on its own. Again, this isn't a recommendation to buy it. It's why it's on my watch list, and why I think the standard "the deal is dead" take you've probably seen elsewhere is missing the most important update. Let's bring this all the way back to where we started. The Treasury Secretary asked the Fed to widen a dollar pipeline for Japan. That request alone is a signal, not proof of a crisis, but a sign that policymakers are quietly preparing for stress before it becomes a headline everyone's forced to react to. History says that when the Fed expands how dollars move through the system, asset prices tend to drift higher over time, and cash sitting still tends to quietly lose ground. From there, we looked at two very different ways that shows up. Alphabet, a mega cap trading at its cheapest multiple in years, despite a cloud business growing 82%, and a Texas AI campus that reframes its spending as demand-backed rather than speculative, with the honest caveat that its free cash flow is currently negative while it builds. And ZIM, a merger story, most finance content has already declared dead, when in reality there's now a second, higher, more politically workable offer on the table that changes the entire calculation. None of this is a prediction, and none of it is personalized financial advice. I'm not a licensed advisor, and everything here is a starting point for your own research, not a replacement for it. If you want more breakdowns like this, how to read Fed facilities, merger arbitrage situations, or valuation resets like Alphabet's, that's exactly what this channel does every week, so consider subscribing if you found this useful. If this video helped you make sense of a confusing week in markets, share it with one person who'd get something out of it too. I'll be back soon with an update on how this plays out. Until then, take care of your money, and I'll see you in the next one.